Good afternoon to all of you. Today, I wish to welcome you to the CMA webinar on revisions to International Integrated Reporting Framework. So we have with us today our Vice President and also the Vice President of SAFA, Mr. Hennayaka Bandara. Our presenter, Professor Graham Terry. Our moderator, Associate Professor Latmika Pereira. Professor panelists, Professor Samanthi Sena Ratna and Mr. Suresh Kunratna. Members and participants at this seminar that we are having, it will be actually seminar cum workshop, and the presentation would be made by Professor Graham Terry. As you know, we have been having many events which have been in close proximity. We first had the CMA Excellence in Integrated Reporting Awards 2020, that was in December. Then in January, we had the judges report, which was presented by Professor Graham Terry, and we had all our judges present who are also present here today. And today we are going to discuss about the revisions to the International Integrated Reporting Framework. This is the first time that a revision has been done from the original framework in 2013, and we thought that it would be good to have it early because many of the companies are preparing their annual reports, especially the banks as at 31st December, and then of course the other companies as at 31st March. So this will really help them to look at the changes that have taken place, and indeed grateful to Professor Graham Terry for accepting this invitation and also for doing all the spade work to enable you to listen to his address. Now, there has also been certain new developments that have been taking place in the integrated reporting field, where the IIRC has is now working closely with the International Federation of Accountants, with the International Accounting Sustainability Standards Board and the IIRC, where they are planning to get together and form what is called a value reporting board or council. So these are some things that will happen soon, and the annual reports would then be much more simplified in order that everyone would be working together. So today, Professor Graham Terry will speak to you on the changes that have taken place, the revisions. I am also happy that Mr. Suresh Kunratna, who is present here, he was there at the inauguration of the revisions that took place, and we are very proud that a Sri Lankan company, Demos, who have been one of the pioneers in this field, were invited and for the revisions that took place. So he is also with us today. So let me thank Suresh for accepting our invitation, as he always does, and also carrying away all the awards from CMA for the last so many years since we started. Just a brief of Professor Graham Terry. As you know, he is a member on our panel of judges and was there from the beginning, and someone who has helped us a great deal in getting together our judging criteria, because he has had a lot of experience in South Africa. He was earlier with the Institute of Chartered Accountants of South Africa, and he's himself a fellow chartered accountant from South Africa. So he has been able to work with us very, very closely last 6 to 7 years, and I'm happy that our entire team has been there from the beginning, and they've been able to work very closely and do a very excellent job. Then he's also an integrated reporting advisor. And as I said, he's been advising us also on many matters. He's been preparing the judge's report, and today, where he is making the presentation on the revisions to the International Integrated Reporting Framework. He's an ambassador for International Integrated Reporting Council, where he's able to promote the integrated reporting, and in this concept, he's been doing quite a lot. And he's also a professor of practice at the University of Johannesburg in South Africa on integrated reporting and thinking. He has also been involved in a great deal in integrated thinking, where they put out a publication, and he was one of the chief authors of this publication. So that's, before I invite Professor Graham Terry, I will just refer to our panel also. As I said, Associate Professor Dr. Lakmika Perra has been involved with us for a long period of time. He is also one of the judges and has been playing a very, very important role. He is the Director Education, Center for Integrated Reporting, Faculty of Business Law of the Deakin University, Melbourne, Australia. I know that they are now under maybe lockdown, maybe for a few days, but I hope Sri Lanka will not fall into the same pattern, and that we will be able to overcome this. Then we have Professor Samanthi Sena Ratna. She's also one of our key judges. I think she's very, very closely involved in integrated reporting, and currently doing, I think, research with the World Bank, and I'm sure that she will be able to give a lot of good information about our integrated reporting in Sri Lanka. She is a professor in accounting, Department of Accounting, Faculty of Management Studies and Commerce of the University of Sri Jayawardhanapura. So we are very thankful for the support she has been giving us throughout. And then, of course, as I told you, Mr. Suresh Kunratna is Director and the Chief Financial Officer of Diesel and Motor Engineering Company, or DEMO, and one of the pioneers in this field, and not only have been doing it, but they've been doing it to achieve excellence. So I must congratulate him, and I'm very happy that he's here with us today on the panel. And as I said earlier, our Vice President and currently the Vice President of SAFA, Mr. Hennayaka Bandara, who's our Vice President. He is also in the banking field and also on the SAFA ITEC committee, which is dealing with the integrated reporting and annual reporting. So I'm sure that he will also be able to take whatever that is required to SAFA. So with those initial remarks, I will now invite Mr. Graham Terry to make his address. I think he's having a presentation. Let me enable the, panel is, right. Okay, fine. Right, Graham, screen sharing is permitted so that you can do your presentation.
Thank you very much indeed for those kind words. Let me just set up the screen sharing.
Yeah.
Is that coming through?
Yeah, it's there. Yeah.
Okay, thank you. Well, firstly, good afternoon to everybody and to my colleagues. And I'm also very pleased that Mr. Ratna is with us today, because he will keep us honest. He was part of the team that put together these changes. So if I don't get it right, I'm sure he will step in and tell me where I'm wrong. So let me begin by saying that this is not a major change to the framework at all. In fact, the international body has said this was a light review. So there are no really significant changes that have come through, but I think it's worthwhile looking at them and understanding them. And hopefully this presentation will help you to avoid having to sit down with the two frameworks to identify what those changes are. So let's just do a little bit of background. You will know that the original framework was published in December 2013. And the IRRC's strategy was really to publicize and encourage the implementation over the first few years. But clearly, with any new framework, before it's really been tested, there are going to be some issues where the framework doesn't necessarily cover all of the areas. So in February 2020, the IRRC invited public comment on selected themes around the framework. And I think they received just over 100 comment letters from the public and from various countries and so on. They took those into account, and then in May 2020, they issued a consultation draft and a companion document discussing various possible changes to the framework, and also asking some additional questions where they wanted to get feedback on certain issues. They held numerous consultations around the world, including Sri Lanka, and I attended that one, and invited comments on the consultation draft to be submitted by the 19th of August 2020. And as a result of that, the 2021 revised version was published. And as I said, Mr. Suresh Gunaratne was part of that team that put that together. So the objectives of the revised framework are pretty simple. Firstly, they wanted to refine recommendations where some confusion existed, and there are a few of those areas. They wanted to make the IR framework more flexible to accommodate legal restrictions and legal frameworks. And they wanted to emphasize certain important aspects. So as you can see, it's not a significant revision of the framework. To summarize the changes, and we will talk about each of these areas. Firstly, value creation, preservation, and erosion. The primary purpose of an integrated report, we'll talk about that. Responsibility for the integrated report, supplement to the statement of responsibility, purpose statement, and finally some changes to the business model. So let's begin with value creation, preservation, and erosion. We all know about value creation. We talk about value creation, but behind that, and certainly in the first version of the framework, it always envisaged value creation, value erosion, and value preservation. But not all organizations recognized that. And many or some pursued the value creation and avoided value erosion, or diminution as it was called in the first framework, and value preservation. So let's just look at what changes have taken place around this and just talk a little bit about it. Firstly, the only real change to the framework is that wherever value creation is mentioned now, you have the words preservation and erosion added to it. So it says value creation, preservation, and erosion throughout the framework. So it reminds us every time we see value creation, don't forget about preservation and erosion. Let's just look at value erosion. Where does value erosion happen? Well, firstly, it's not only erosion for the organization, it's also value erosion for stakeholders. So obviously it affects the capitals because that's where the store of values resides. So from a financial capital point of view, value erosion can happen with trading losses, loss of access to capital. It could be stock write-downs, a whole host of financial ways in which financial capital can be eroded. And I'm sure you can think of many more. Human capital could be a loss of employees. I can think of one example where it might happen would be, for example, investment funds, where they usually employ teams of people to look after the investment of funds. And sometimes these teams decide they want to start their own fund or they want to move to another fund. So that would be a major loss for that organization. So that's one which I've seen several times over the years. Intellectual capital could be a loss of ownership of a patent, for example, challenged in law or something, or software which they've developed, loss of competitive edge where perhaps other organizations have found better ways of meeting the demands of consumers, etc. So it could be intellectual capital. Social and relationship capital could be a decline in the value of brand, reputation, scandal. We've seen many reputation scandals in South Africa of late in the last few years, which has had a massive impact on the social and relationship capital. Loss of license to operate might be in a country where the organization has a license to do certain things and it can lose that. So that could be an example of social and relationship capital. Manufactured capital, loss of plant and machinery, loss of the right to use infrastructure. For example, an organization might have an agreement to use a rail link, but for some reason that agreement falls through or the rail link is closed down or whatever. And then finally, natural capital. And of course, this is where most of the erosion would take place because virtually everything that you do has an effect on natural capital. So it could be pollution of the atmosphere, rivers, the ocean, land, etc. So there are a lot of areas where value erosion can take place, both for the organization and for stakeholders. If we look at value preservation, organizations can and often do have value preservation strategies. In the case of financial capital, the organization might be looking to the future and saying, look, we believe that our currency is actually going to decline in terms of our major trading partners, and we need to do hedged transactions. Human capital, for example, the banking area. We all know that banking is moving away from over-the-counter type transactions to digital transactions. And are the people that are employed by the bank able to cope with that? Are they adequately trained? So they might need to invest heavily into doing that. Intellectual capital might be the need for research and development to maintain market leadership. Social and relationship capital might be programs to promote the image and brand, where perhaps the brand is losing out to competitors and really needs to preserve that value and enhance the brand. Manufactured capital could be a large investment to promote or to modernize plant and machinery, just so that the organization continues to be competitive. And natural capital investment in technology to reduce pollution. Government might be bringing in additional requirements as regards greenhouse gases and so on. So just to preserve the value of the organization would need to invest and improve the technology. So these are just some examples of value erosion and preservation. But where it really happens very often, where we see this in the integrated report, is in the capital trade-offs. Because with a capital trade-off, and a simple example of a trade-off might be where you enhance your human capital, where you train your staff, your employees, but there's a cost in doing that. And that cost would affect your financial capital. So that would be an erosion of financial capital to enhance your human capital. So that a lot of these erosions and preservation strategies would be affected in the capital trade-offs. These would have to be and would be significant and material trade-offs. So it's not just everyone. These would be material ones, but really one needs to be aware of these. And what is pleasing to see in Sri Lankan companies now is that many organizations are dealing with these capital trade-offs that take place. And when you're dealing with the capital trade-offs, you're obviously then taking account of the erosions that might occur. So as far as the framework is concerned, the changes that are happening are every time you see the word value creation, you see the words preservation and erosion as well. So it's important that organizations are aware that it's not only value creation, but it's also preservation strategies and value erosion. Let's move on then to the primary purpose of the integrated report. Now, there's no change here, but you will remember, those of you who attended the workshop that was held in Sri Lanka, that there was a lot of discussion as to whether or not the purpose should be changed so that it would become providers of capital versus providers of financial capital. And really where this came out, it was one of those areas at which, or for which, there was a question asked. And I believe that that about half of the people who replied to that original request suggested that it should be providers of capital, and about half said that it should be providers of financial capital. Now, the IRRC said they were not going to change this, but they wanted feedback on it. So it remains providers of financial capital, and obviously one needs to be aware of that when you're preparing your integrated report, and the framework has been structured around providers of financial capital. But where a change has happened, and this is one example, is that it's where how the organizational, let me read it from the beginning. The primary purpose of an integrated report is to explain to providers of financial capital how the organization creates, preserves, or erodes value over time. Let's then move on to the responsibility for the integrated report. And this is contained in paragraph 120. And there are some changes here. And it might appear fairly complicated as I go through it. But I will summarize it at the end, and you will see that it's pretty simple. So paragraph 120 started off by saying, an integrated report should include a statement from those charged with governance that includes an acknowledgement of their responsibility for the integrity of the integrated report. Now, that's not changed. That section of this paragraph stays exactly the same as it was before. So just to repeat, an integrated report should include a statement from those charged with governance that includes an acknowledgement of their responsibility to ensure the integrity of the integrated report. The second bullet said an acknowledgement that they have applied their collective mind to the preparation and presentation of the integrated report. That bullet has now been taken out. That's no longer a requirement. The third bullet said the opinion or conclusion about whether the integrated report is presented in accordance with this framework. And that has changed slightly. The words or the extent to which have been added. So it's their opinion or conclusion about whether or the extent to which the integrated report is presented in accordance with the IR framework. Now, I'm going to come back to this in a few minutes' time. I just want to finish the changes to this paragraph, but you don't need to worry too much about this because it really only applies to organizations that are starting out on the journey, and you'll see why in a moment. So carrying on with this paragraph, the next section said, or if it does not include such a statement, it should explain what role those charged with governance played in its preparation and presentation, what steps have been taken, and the time frame. Remember, this is the statement around the responsibility for the integrated report. Now, that whole section has been taken out, and it's been replaced by where legal or regulatory requirements preclude a statement of responsibility from those charged with governance. This should be clearly stated. Okay, so it takes away the option for organizations not to provide that statement of responsibility, except where there are legal or regulatory requirements that preclude a statement of responsibility. And there are some countries where that happens. I know in some states in the United States, that is the situation. So where legal or regulatory requirements preclude a statement of responsibility from those charged with governance, there needs to be an explanation of measures taken to ensure the integrity of the integrated report. So there would need to be disclosures along the following lines: related systems and procedures and controls, including key responsibilities and activities, and the role those charged with governance, including relevant committees. So really giving some sort of quality control disclosures as to what the organization has done to protect or to ensure the integrity of the report. Now, let's come back to the extent to which the integrated report is presented in accordance with the IR framework. And the extent is evaluated against the requirements identified in bold italic type and summarized in the appendix. So if you look at the framework, and this was true in the original framework, there were certain paragraphs that were in bold italic type. And those paragraphs are the ones that had to be complied with for you to call your report an integrated report. Now, they were summarized and are summarized at the back of the framework in the appendix. And you can see here, using the IR framework, you can see paragraph 112, 117, 118, 120, 333, 36, etc. So in that appendix, you've got all the requirements that organizations have to comply with. Now, reporters that have been reporting for years comply with these. But where an organization is in the process of adopting the IR framework, it is appropriate to identify which requirements have not been applied and the reasons why. And you will all know that when you start out, it's virtually impossible to comply with everything in the first year. There's usually a journey over which you tweak and get your report to comply with all those requirements. So this really only applies to those organizations that are starting out on this journey to prepare integrated reports. Now, in applying paragraph 120, the organization needs to take into account its own governance structure, which is a function of its jurisdiction, cultural and legal context, size, and ownership characteristics. What does this mean? Well, for example, some jurisdictions require a single tier board, while others require the separation of the supervisory and executive management functions within a two-tier board. Now, Sri Lanka has a single tier board, so that is fine. But where you have a two-tier board in countries like Germany, France, Netherlands, and I think Malaysia as well, they have a two-tier board system. And so then it's a question of, well, which board needs to give this statement of responsibility? And the framework says in the case of two-tier boards, the statement of responsibility is ordinarily provided by the body responsible for overseeing the strategic direction of the organization. So it would normally be the supervisory board and not the management board. And it goes on to say, to try and clarify this, it is important to consider the intent of paragraph 120, which is to promote the integrity of the integrated report through the commitment of the body responsible for overseeing the strategic direction of the organization. Now, as I say, this doesn't really apply to organizations in Sri Lanka because you have the one tier approach. But if you, for example, trading in Malaysia, then maybe this does become an issue. Then finally here we have the suggestion, or the suggestion, I guess, recommendation that the organization should also present a supplement to the statement of responsibility from those charged with governance, as this information indicates measures taken to ensure the integrity of the integrated report. So it's also helpful in the report to have a supplement stating what quality control procedures the organization has employed to ensure the integrity of the report. Yes, it's great and it's important to have that statement from those charged with governance, but it's also useful to have a statement or disclosures around the quality controls. And we saw some of those in Sri Lanka last year. And one that I can highlight is John Keel's, where they show some of the information that one might expect to see with regard to such a statement. So I said I would summarize this at the end of this discussion on paragraph 120, and it is fairly simple. Firstly, the integrated report should include a board statement of responsibility. That's the bottom line. If the legal framework does not allow the board to make such a statement, then there should be an explanation of measures taken to ensure the integrity of the integrated report. And if the organization has just begun its journey to produce an integrated report, and it has not complied with all the requirements, then the board should disclose the extent to which the integrated report is presented in accordance with the framework, and it would measure that in terms of the bold italics paragraphs or the appendix at the end of the framework. And then finally, process disclosures are encouraged as a supplement to the statement of responsibility. So it's fairly simple what the paragraph 120 is now requiring of organizations. Now, just one last thing with regard to this is the definition or description of those charged with governance. What does that actually mean? It used to say the persons or organizations, e.g. the board of directors or corporate trustees, with responsibility for overseeing the strategic direction of an organization and its obligations with respect to accountability and stewardship. So they've now added an extra sentence to clarify this because there were some issues around that. For some organizations and jurisdictions, those charged with governance may include executive management. And I think in Sri Lanka, you would see boards, I'm not sure, but I think you would see boards that include CEOs and CFOs. The management wouldn't dominate, but there would be representatives of management on the board. And there are a number of countries around the world where that is common. And so therefore, by changing the definition, it makes provision for boards where those situations exist. Let's move on to the purpose statement. Now, we're seeing around the world, many organizations are producing or describing their purpose statement. It's quite common in many countries. And there's a reason for this, because it really talks about the reason why that organization exists. And the purpose statement is used as a driving force in decision-making, reflecting the organization's core values. it goes actually beyond the vision and mission and values of the organization and states why that organization exists. And during the COVID-19 pandemic, I've seen several organizations where they've had to change their business model or strategy, and they've used this purpose statement saying, okay, that's who we are, that's why we exist. We can now adjust our business model to take into account the changes that have happened in the external environment, and we can now address these changes as a result of COVID-19. Now, where it comes into play, it's not a requirement. It comes into the framework a few times, but if you look at the content elements, the first one is organizational overview and external environment. Okay, and it says there, an integrated report identifies the organization's purpose, mission, and vision, and provides essential context by identifying various matters. That is the content element. It's not saying you have to have a purpose statement at all. It's just saying that if you do have a purpose statement, then it's helpful to disclose what that is as well. And interestingly, there are some companies in Sri Lanka that have purpose statements. Oxford College of Business was one we saw last year. DEMO also has one. And if you look at the Oxford one, their purpose is to empower people to progress in their lives through learning, enabling them to acquire the knowledge and skills to thrive in an ever-changing and increasingly connected corporate world. So you can see that's why they exist. And based on that, you can decide what your vision and mission and your business model and your strategy is. And it really is a helpful kind of statement that anchors the organization and describes its reason for existing. We now move on to the business model, and this is the last element that we will discuss in this presentation, because there are some changes to the business model. This is the diagram of the business model that existed in the first framework. Okay, we all, I'm sure, are familiar with this diagram. It has changed slightly. Apart from being more colorful, there are some subtle changes to it as well. The first one I'll highlight is, you can see here, it says figure 2, process through which value is created, preserved, or eroded. Okay. Now, the first change that I want to highlight, or major change that I want to highlight, is that you can see that shaded blue area. In the previous version, the shaded blue area started within that white box. And you can see it's now been extended outside of the box. And that is to show that the inputs to an organization not only flow from the organization, but they can flow from outside as well, from stakeholders, etc. So that's to illustrate that it's not only internal capitals that are taken into account, they can be capitals that are provided by stakeholders. The second change relates to the process through the business model. And you remember that there was a straight line that went from inputs to business activities to outputs to outcomes, which implied all the outcomes flowed from outputs. But if you think about it, there are outcomes that flow from business activities. For example, if you're constructing new plant or machinery or whatever, that's not an output. That flows from business activities. So they've now split it so that your outcomes flow both from business activities and outputs. And then you can also see that the blue shaded area goes beyond the white box of the company. So the outcomes can affect not only the organization, but also stakeholders. So those are the main changes to the diagram that have been made. Also, just to remind organizations that the diagram, and some organizations seem to just take this template and use it in their organizations. But one needs to look at the specific business circumstances of the organization and tailor this diagram to meet those circumstances. Now, paragraph 419 just emphasizes what I've said about the diagram, and the sentence has been added. It says an integrated report describes key outcomes, and then it's added the words, outcomes are the internal and external consequences, both positive and negative, for the capitals as a result of an organization's business activities and outputs. And then it goes on to talk about both internal outcomes and gives some examples, external outcomes and gives some examples. And there's can be positive outcomes or there can be negative outcomes. Now, the two bullet areas were in the original framework. It's just the area or the sentence that's highlighted in yellow that has changed. Now, they've also added an example to differentiate or to show the distinction between outputs and outcomes, and the importance of a balanced consideration of outcomes. And this example is around an automotive manufacturer that it produces internal combustion engines. I think there was a similar example in that discussion paper that was put out. But firstly, we need to know that the outputs are what the organization produces. It's cars, it's internal combustion engine cars. Those are the outputs and the outcomes of the effects on the capitals. Now, there are still some organizations in Sri Lanka, certainly last year, that seem to mix up those two concepts, but it's important the outputs are the products or services that the organization puts out into the marketplace, and the outcomes are the effects on the capitals. And the effects on the capitals need to be balanced, and quite often we just look at the positive outcomes and forget about the negative outcomes. So some examples that are given as regards positive outcomes would be for this automotive manufacturer would be increases in financial capital, that is profits to the company, and supply chain partners, shareholders, dividends, and local tax contributions. So that would be from a financial capital point of view, and these are just examples. It's not meant to be complete. Enhanced social and relationship capital, improved brand and reputation, underpinned by satisfied customers and commitment to quality and innovation. So that would be examples of the social and relationship capital. And the negative outcomes, adverse consequences for natural capital through product-related fossil fuel depletion and air quality reduction. And then as regards social and relationship capital, product-related health and environmental concerns of the social license to operate. So it's important to give both the positive and the negative, and obviously the material aspects with regard to these. So really that example then wraps up the changes to the framework. And I hope that's been helpful to you to understand what those changes are, and will enable you to deal with them as you see fit without having to spend many hours going through to trying to identify what these changes are. So with that, I will hand this back to Professor Watawala to continue with this event.
Thank you. Thank you, Graham. I think you've gone through the main areas, and I'm sure that I would like to now hand over to our moderator Associate Professor Dr. Lakmika Perra, so that he could make his initial comments and then maybe raise some matters with the panelists.
Sure. Thank you, Professor. Thank you very much, Professor Watawala, for inviting me for this session and giving me the honor of coordinating this panel discussion. So first and foremost, my comments are that the changes are very light touched. In other words, the IR framework, their viewpoint was that if it's not broken, we don't need to redo it too much. We'll just do a little bit of a tweak. So that's a positive thing. So in saying that, there are also other questions in terms of questions asked by academics and practitioners on how this can go towards the next iteration or the next level with some more serious changes that can further enhance the framework for what it's supposed to stand for. So in that context, I would like to also encourage participants to ask questions in the chat engine, and I will raise those questions with the panelists as and when they arise. But also, until such questions are raised, I will ask a couple of questions myself, which I thought were relevant for practitioners to hear from the panelists. So my first question is to you, Suresh, and that is not a surprise given that you have been one of the first to initiate this in 2013 as a pilot study. So how does these changes affect the dynamics of how DEMO would present its IR report in the coming year and going forward? Has the changes made a significant impact on how you report? In other words, does it have a fundamental impact or change the way that you will present your report in one way or another?
If you ask me, if I use the word fundamental, it's a definite no. I think from a user's point of view, the most significant explanation or the clarification or change is the emphasis on outcomes. Because integrated reporting, now if you look at capitals, the basic premise for capitals is where it's a store of value. So the value that gets created is manifested in capitals. Now, if we go on those lines, it is the outcomes finally make these manifestations possible. So bringing into clarity in the business model where business activities and outputs both are recognized as points of delivery or aspects of delivery of value, I think is a fairly good clarification. I won't call it a change. That thinking was there. I think what has happened is they have made it, told it very precisely. So this will, in general, I think will open up a lot of companies to better understand integrated reporting, and that will bring a lot of clarity. I think that's a very, very good move. I think that is, to me, that is the most significant change or clarification that has come. Apart from that, there is clarification with regard to the governance aspect of integrated reporting, in the sense about this taking out collective mind terminology and things like that. Those have mildly, okay, that I think makes more sense. And also they are recognizing integrated reporting as a journey. That is why it is said that people who are doing, you can specifically say the area that is not that you are not complied with, and so they are allowing people to recognize this as a journey, and that's a big encouragement, I would say, rather than earlier, like before, having to say that we have complied with everything. So I think those are positives that we have to take. So also, I think they have made the balance of reporting more objective by trying to describe the outcomes in terms of positive and negative outcomes, and in terms of short, medium, and long term. Because for integrated reporting, I think if most of us have not focused enough on the long and medium term. So by specifying that, I think that brings in a lot of value, because if you are looking at the future value of an organization, definitely some thoughts have to go into medium and long term. Otherwise, we are only looking at the short term, and if you look at the short term, it's mostly financial, because it's quite close to what we do at the moment. We get the present value of future cash flows and try to value a company. So if you want to go a step ahead, I think it's important that you look at medium and long term. So those are the things. To answer your question, I don't think we will fundamentally change the way we prepare our report, but it has brought more clarity, and I'm encouraged that everyone in general has got more clarity.
So is it right to say that it's not the integrated reporting component that has changed through this through the updates to the framework, that it's actually integrated thinking that has actually changed?
Yeah. Yes, you are right. Finally that gets manifested in the integrated report. For example, if I talk of short, medium, and long term, yes, we need to think about the impact, but then that has to come to the report as well. But if you take my previous example, where they have brought clarity in terms of business activities and outputs and the resultant value created or eroded, yes, then it's actually about thinking.
Thank you, Suresh. I think that was very enlightening from a practitioner's perspective. As a pioneer, it's nice to hear that how this has affected you. So my next question would be to Graham, in terms of the presentation of the framework. So this is a bit of a controversial question, and I think you raised it very well in terms of the purpose of the IR framework and its audience, its primary communication audience. So do you think that the IRC has gone enough in changing the focus of the report from those who provide financial capital and the broader providers of capital? So this has been a contentious issue, as you rightfully said, in number of forums. I took part in a couple of forums in the Asia Pacific region, in Australasia, and this debate has been coming up over and over again. Is there a reason why the IRC didn't have any changes done to that particular viewpoint, given that the IR framework looks at 6 capitals, though its reporting framework, they're talking about it being mostly targeted to providers of financial capital and not necessarily the another 5 capitals? So is there a contradiction here from an academic perspective, or is there something else that ties these things together?
Well, I'm sure we will all have views on that. I think that firstly, when this document was put out for comment and in the discussions, it was made clear that the IRC was not going to change the situation or to change that the purpose of the integrated report, and that they were really looking for feedback from practitioners and organizations around the world to perhaps give them more clarity on which way this should go. And I think the other important element here is that a lot of people support retaining it as providers of financial capital, and a lot of people believe that it should be expanded to all forms of capital. But I think it's about a 50-50 as I understand it at the moment. And I think that's what came back to the committee, but maybe Suresh can talk about that. But the thing is that it is a difficult area, and it sounds the right thing to do, to expand it to all forms of capital, all stakeholders, I should say. But then the question comes up: if you do expand it for all providers of capital, do you need to change that framework? Because it's being constructed for providers of financial capital. So if you do change it, would it require fairly significant changes to be applicable for the other providers of capital? And the framework does say that the framework as prepared at the moment is also applicable and useful to other stakeholders, but maybe it would need to change really significantly if you took out that requirement for financial capital. But just a short comment that I would make, and this is just an observation and has no merit in it, except that by working more closely with the SASB, are we not just reinforcing financial capital as the purpose? And it's just and maybe Suresh can answer that question, but that's a bit of a tongue-in-cheek.
Suresh, do you have any comments?
This is my personal, this is my personal view, of course. I think Graham, when he asked that question, he answered that as well. Is it necessary to have a separate report to look at the value that we create for the stakeholders? Okay, as directors of the company, they have this stewardship responsibility and towards all the stakeholders. That is correct. But a company has been convened for finally the ultimate goal of all this is creating value for shareholders. So, and also we must understand that shareholders benefit that value through the financial, through financial means. I won't say financial capital. So, if on the other hand, it is obligatory for an organization to be legally obligatory for an organization to be accountable towards the shareholders. Not to say that they are not legally obliged towards the stakeholders. They are. For those, they are a separate contracts and so on. But when you look at the whole picture, we must understand that a company is constituted to create value to the shareholders. So the basic obligation of the leaders or the party, those who are charged with governance, is to make sure that they are accountable to them. Then while doing that, while being accountable towards the shareholders, you cannot now, the basis of integrated reporting is by providing an account of the financial capital, you are not showing you are not discharging that accountability. To discharge that accountability, you need to show how you have dealt with your stakeholders because they are part of your capital. So when you do that, automatically, I think what the stakeholders need to know come into play. I don't think we can, if we are believers of integrated reporting and integrated thinking, I don't think we can talk of a value of a company or discharging obligations towards the shareholders without talking about the other stakeholders. So I think it happens. I don't see the need for a separate report. So, and then if you may ask me why not include stakeholders as well, but I think the obligation, the legal obligation and the main obligation is it's mandatory. It is towards the shareholders. So while doing that, the other accountabilities are they become transparent. They become they have to be discussed.
Yeah.
So I'm not sure whether IRC should take it upon themselves to look after the interests of the stakeholders. That may not be the purpose. Even sustainability reporting, finally, we look at our responsible value creation for the shareholders. So when we talk about that, when we discuss that, consider that, we need to talk about all the stakeholders because they make it possible. So I don't know, I may not have given a very clear-cut answer. I just threw my mind out to...
Thank you, Suresh. I think between you and Graham, I think you have covered the essence of it. In other words, for regulatory requirements are the primary purpose is to communicate with the shareholders, yes, but what integrated thinking does is that it actually captures all the other stakeholders or all the other providers of capital. In providing this information, integrated thinking comes into place, and it automatically captures that requirement of the other providers of capital as well. I think that is clear with what you have mentioned. So thank you. Now, there is a question by Dr. Mohan Rao. So I'm putting this question to Professor Samanthi. The question is, integrated thinking among all participants is essential for effective integrated reporting. How do you ensure integrated thinking? So in that particular discussion, Professor Samanthi, can you also touch on the statistical significance or the significance of the changes in terms of how you see it from an academic perspective of the changes and what kind of effect it will have from an academic perspective in the business field?
Thank you, Lakmika. Let me start with your second part of the question and come to the integrated thinking,
Sure.
Because that will help me to provide an answer to the first part of your question. I think with these changes, as Graham said, it's a light change, but that light change has made things more clear. Particularly, now the organizations have to put their purpose statement. So then they will get that. I think that would be the starting point of the whole process. We should understand the purpose. Why are we? What is the purpose of having this particular organization? I think that is clearly mentioned in the new framework, because earlier also it was there like vision and mission, but not as the purpose. In my opinion, so this putting the purpose of the company is a very it's a important change that we see in this framework. Then we will get to know and we will think what is the purpose for which that this particular entity would exist, and the interactions within the entity as well as with the entity and the external environment or the society in which it operates. Secondly, I think because the purpose is clear, now they can clearly see the distinction between the output and the outcome better. The point is this value creation, because most of the time when we see the annual reports also, the tendency is the company to report the value that they have created. So, but value creation doesn't mean only that you have positive, there's a positive change in the capital or an increase in the capital. There can be even decrease as well as you have been able to preserve in a times like in a pandemic situation like COVID-19. It's, in my opinion, it's maintaining the capital is the biggest challenge for an entity rather than creating the capital, because then you can avoid the erosion of the capital. But sometimes the erosion is there. You will be seeing an erosion, and that will make you to think whether the strategies were wrong or there were any problem with our strategies, or whether the strategies were good or there were problems in the implementation. So in my point of view, if I summarize, the main developments I see as the positive changes in the framework are the purpose statement, making the organization to write their purpose and also to think them broadly about the value. So it's not only the creation, erosion, as well as the maintenance. So if you put these things, if you understand that correctly, the companies will tend to understand both the positive and negative outcomes of the organization to the different capitals. Now, if we take for an example a university, now particularly in Sri Lankan context, all the universities are state universities. But if you think of the financial capital comes from the government. The government provides the capital. The main provider is the government. But there is no increase of capital as such, financial capital, because you are not making a profit at the end of the day. But what matters is the other other capitals that to which the university is contributing: intellectual capital, social and relationship capital, the human capital, and even the maybe directly as well as indirectly to the natural capital of the country. So in a way, so then uh, I think that is why it is important for us to understand this big picture of value creation. It is not only for the organization that you are creating a value for the organization, as well as for the other stakeholders in the society. So in that perspective, these three changes are critical changes in my point of, as I understand, as I believe. And the other thing is coming to that question of integrated thinking. I think now, so the question is, should the all parties understand that? I think when you put the purpose of existence, when you write the purpose of having this organization or the purpose of existence of a particular entity, certainly that will explain, that is the starting point of your integrated thinking. So the organizations will get to know the purpose. The stakeholders who are contributing to the organization will get to know the purpose. So as correctly identified by the in the question, yes, everyone has a role in it. Now, if I take the same example of the universities, why should universities exist in the society, right? Is it because the government is providing funding, or is it as a center of higher learning? So, what the university could do to the society? So, that university needs to understand. Also, university cannot operate in isolation. Therefore, there are different stakeholders with which the university interacts. The schools, the industries, the employers, the profession, etc. So in a way, like then when you put your purpose across correctly, when you identify the reason for existence, so you will get to know everyone who will be part of that entity and who would be affected of that entity will start developing in a broad manner. That system thinking will be developed. Therefore, I to agree with the question, yes, if the integrated thinking to be introduced or developed, everyone who is involved in that particular entity needs to embrace that concept.
Thank you
I
very
hope.
much, Professor. I think that really puts into context how and the importance of integrated thinking and how they play in the example that you gave, particularly with universities. So that's absolutely fantastic. And now my next question is to Mr. Hennayaka. Mr. Hennayaka, are you there?
Yes, please.
Thank you. So, Mr. Hennayaka, you've obviously watched Graham in his presentation where he eloquently presented the changes. And one of the things I enjoyed was in terms of the framework where it was extended. Some of the effects were extended in terms of inputs and in terms of outcomes that go beyond the organization. Now, in terms of management accounting, and the perspectives of management accounting, was more importantly strategic management accounting in the context of IR. Do you think that the changes provide more emphasis for the importance of strategic management accountants to be more involved in the IR space in your capacity as office bearer of SAF as well?
Yeah, thank you, Professor. I think yes, answer is yes, because as far as management accounting is concerned, if you take these new changes or other suggestions, will definitely further improve the corporate reporting. If you go back, I mean, from the beginning, the IR framework has progressed the quality of reporting around the world and has enabled businesses to assess their ability to create value in the short, medium, and long term to improve their communication with investors or other stakeholders. So I think with this new changes, definitely it will further improve the corporate reporting.
And how do you think that the management accountants or strategic management accountants can take ownership of these changes that will propagate their current stance in terms of expertise in integrated reporting and integrated thinking?
Yeah, what I can see is if you take the current environment in most of the companies, the general perception is that even though they are producing the integrated reporting, it appears that they do not have the integrated thinking. Plus, they are not fully aware of what is happening inside the company. I mean, with due respect to all these companies, they get some kind of outside resources to produce all these reports. So there is a gap between their knowledge as well as what they are reporting. So I think that it is very, very important for us to really to make all these accounting professionals are aware of the exact meaning of or rather the importance of the integrated thinking.
Thank you, Mr. Nayaka. That was very enlightening. Now, my next question is to Professor Vatawala from a macro perspective. So if you look at this, the changes and the IR framework from macro perspective, while these changes are very subtle in terms of how they have been pitched, I think they have a significant impact in terms of how the framework is interpreted. So from that perspective, how do you see the macro level in terms of Sri Lankan context, where the subtle changes that has been made can be adopted or made use by the SME sector for bettering their cause?
Thank you, Professor Lakmika. Just to maybe go on the management accounting area, as you know, management accountants are more involved with the internal management. You see, when you say internal management, really helping the CEO, the board of directors to run the company. Now, like Professor Samanthi mentioned, the purpose. Now, this is very, very important, you know, the purpose of the organization. Now, as she mentioned, so that means that we bring together all these people, you know, especially the management accountants have now to play a very, very important role because once you have a purpose, and today one of the biggest problems that we have is most of these things are discussed at a maybe a lower level, but it doesn't go to the top, you know. So now when we have this real purpose being defined, the board also has to get involved, you know. So that's what I feel. Maybe in places like BMO, they are maybe all involved, but I don't think in all the institutions that is involved, you know. So that I think is a very, very significant thing. And also for the directors, it is not only the short term. Now, if we are looking at a long term, then again, a lot of thinking has to go into as to how you can maybe survive in the long run. So that's also an area where I feel that the management accountants and also the senior management, the CEOs, the MDs, the CFOs, the board have to get involved. So I think the subtle changes that have been done will really impact most of these companies that are going into the preparing the integrated reports. So I feel it's a very, very good thing that has happened. Although maybe after 10 years, definitely you will find that many more things have to be added, but I think those things would come later.
Yeah.
Because with the value foundation that have been formed, with the sustainability development goals going to come in, I think the bigger changes are yet to come, but now we are really looking at some of the areas that have to be done and will also make the companies prepared for the other greater changes that are going to come to take place and to bring everyone together. Now, that's the most important thing where the difference, especially on the sustainability accounting and also with the sustainability development goals, which they say in maybe 2030, we have to achieve it. Now, this is another thing that I feel is not only for the private sector, but the government sector is very important, because from Professor Samanthi's statement of the universities, now this is the same thing in all the other ministries, because you allocate the money, but after that, what value they create is really not seen by the society. So we are now trying to see how this could be given to the public sector, because this would be a very good thing, the integrated reporting to go into that area. Then on the SME sector, as you know now from the experience that we have had, the SME sector coming into this sort of reporting is not very great, So because they may have other priorities of how what things have to be done, because even some of the public quoted companies are still not coming to the integrated reporting. So I think SMEs have a long way to go, because I feel that maybe it depends on the classifications. Maybe in other countries, some of our companies that are classified under maybe the bigger companies or the larger companies may come under SME sector. But in Sri Lanka, it is going to take a long time. But we must be happy that there is definitely a very, very positive trend, So that's what I feel now when you bring all these things. Now we have the mission statement, but as Professor Samanthi mentioned, this purpose would really create value. And also the other three areas which was mentioned, that is the value, not only the creation, the preservation and the erosion. Now, if these things also have to be reported, then I think a lot of the people are really going to be in big trouble, because today everyone is very happy by giving only the good side. But if they have to give the how they are going to preserve it, and if there's any erosion that has taken place, then I think that's something that we have to look at. And as you say, I think we have to wait, maybe do a lot more work to develop the SME sector to come into that area. But prior to that, maybe we can get the quoted public companies to do and prepare the integrated reports.
Thank you, Professor. That was very, very thorough and very macro level thinking. Now, there is a question about that very point that you discussed in terms of the balanced view. Now, as you know, as you all agree and know, IR reports is about providing a balanced view, the good, the bad, the ugly. And however, once the organizations start giving a balanced view of the erosion, the creation and the sustain of these value creations, we also need the education aspect of it to go hand in hand, the education of the public, the education of the stakeholders. So I think the question is in relation to that. So I mean, in terms of education, yes, that point is absolutely right. There's no point in providing this without actually educating the public as well, those who receive the information, to understand that this is a balanced view and it's a positive view. So the question here is that, should we also educate the readers in order to bring those two, the preparers and the receivers, together and to bring them on the same page? Any thoughts to the panel? Graham, do you have any views on that?
Well, I think the answer to that is yes. It's important to educate all the stakeholders about these concepts. And really the reason for it is that by providing balanced reporting, you're providing better information to all the stakeholders. And also you are making the organization more competitive. But, I think one of these key stakeholders would be the investors and the asset managers and so on. And certainly in South Africa, we've seen resistance to this kind of reporting to some extent from some of them, and initially from the majority, but I think more and more are beginning to see the advantages of looking at organizations from a balanced perspective, understanding all these different aspects that come through in the integrated report, because we live in a very competitive world, and we live in a world that's changing all the time. So I think it's absolutely critical that that this education process takes place, but it's a difficult ask. How do you go about it, and where do you focus your attention? You can talk to asset managers and so on, but how far down the line do you go? Do you talk to general public or whatever? But I think what is important is that the investment managers and so on need to understand these aspects, and they tend to have their own ways of evaluating organizations, companies, and so on, and the investment potential. They also, and we've heard this term, short-termism. I'm not sure what the situation in Sri Lanka is, but many of these asset managers are rewarded on a short-term basis. In the United States, sometimes it's every quarter. We talk about quarteritis and so on. So this long-term thinking sometimes avoid, or they're not interested in it because they're not going to hold the share beyond 3 months. So, I think it's something that needs to take place, but how one goes about it is not that easy.
Thank you, Graham. There's another interesting question.
Can I just make a comment on that? Now, this education is very important because you see now every employee should realize what is the value they are creating. A lot of them are not aware because today maybe people are striking for various demands, but actually whether they realize what is the value they are hoping to create. Because today everyone is looking at maybe the bottom line or maybe some other considerations that are there. So what was mentioned about the education is very, very important, more than the profitability and other. That's why the management accountant is very important, because management accountant will look not only on the financial but the non-financial areas which should come in. So I think I'm sure Professor Samanthi would maybe comment on this, because how the education will be able to take this forward, and if everyone to realize their role, they should know what is the value they are creating, or are they eroding the capital, or preserving it. Now this has really is something which is very, very valuable, and I'm sure from the education side, Professor Samanthi would definitely have a very good comment to make on this.
Actually, Lakshmika, I would like to add one thing to this, because based on a research that we did, and actually Mr. Rajiv Bandaranaike quoted this study when at the CMA annual integrated report awards competition, award ceremony, that in that study we found was on the value relevance of integrated reporting, information reported through integrated reports. So the outcome of the study is an insignificant relationship. So that means the capital market providers are not sufficiently using this information, despite that we prepare integrated reports. So that the investor is not using because they are not being geared to consider those aspects when the investment decisions are being made. In my opinion, several factors contribute to that. One reason is the investment advisors, stockbrokers, fund managers, these intermediaries in the capital market are not sufficiently focusing on this aspect. Other thing, on a personal level, the people are not that informed about these concepts, even though these are developments in accounting. So other thing, and also inside the company, if the information is not taken into account by the managers when they are making the decision, then that is another issue we need to consider. You may prepare a report, but do the managers make use of the information when the decisions are taken? So again, there are various psychological behavioral factors could be impacting on their decision making. so as to not value the information that they themselves generate within the company to use in their decision making. So currently we are on a study, so probably once the study is finalized, we can provide some input in that respect as too. And from the university's point of view, of course, we have already started to incorporate this aspect into the curriculum, and we have been teaching for quite some time. But it is not just the content that would matter, but we must make the student to engage in deep learning in this concept. Therefore, it's not that the concept, but our pedagogy, our assessments, there should be a proper alignment so that the student is deeply engaged in it to understand how practically relevant is this concept. Therefore, now we have done some changes in that respect, and we have actually got the support of the industry. Even Mr. Suresh Gunaratna has supported us in these activities. So again, integrated thinking would require universities should collaborate with the professional accounting bodies and the industry to make this difference to happen in the society.
Thank you, Professor Samanthi. Just adding to that, in terms of the question that was asked for education purposes, I would also like to add, from an education perspective, one additional thing. Most of the time, integrated thinking, I mean, other than in exemplars, most of the time, integrated thinking or integrated reports are managed by a finance team or the reporting team, unfortunately, because then it kind of doesn't come from the top, where it's the board is not fully knowledgeable of what integrated thinking is or integrated reporting is. In most cases, they understand that it will be it'll add values in some way or another, but they don't understand what integrated reporting really is, and they just in some cases they outsource it to the management to run it. But my view is that it has to start from the top, because it has to start from the board, from one aspect, and on the other aspect it has to start with the stock exchange and the investors and the analysts and so forth. So it's a two-tier approach that needs to be taken to inform a board from the top down, as well as parallelly the investors from the top-down approach as well. And that's I think very relevant to what Professor Vattabala was also saying. And this is where the management accountant can play a significant role in both of these aspects. So there is another question in terms of total balance sheets and market capitalizations be tallied to an individual company. The question is, all value creation, how can this be added into the balance sheet? Now, that's an interesting question, and I'll probably give a comment and then ask the panelists for some comments. In terms of the balance sheet, not everything, the first thing I want to add is that not everything can be valued in terms of monetary value. There are non-monetary values as well. There are some of the measurements of value can be non-monetary. It can be descriptions, or it can be other forms of value. So in that sense, not everything can be taken onto the balance sheet, and some must be considered outside of the balance sheet as adding value. Any thoughts from the panel?
Maybe I can answer
yes, please.
that.
Yes, Suresh.
Yeah. Now, say, let's leave aside integrated reporting, leaving now, say, under the former regime or current regime, if one may say so. If we want to value a company, we look at many things. One is we look at the net assets, and mostly we look at the future cash flows. Actually, net assets is secondary, because we don't want to buy a company and strip it and take the money. No, that is not the purpose of buying. So we look at future cash flows. When you look at future cash flows, we really the balance sheet has less significance, because what we look at is the ability of that company to generate cash in the future. Now, when we do that estimate, unconsciously we look at our ability to create value, because our future profits will depend on the human quality of the human capital, quality of the intellectual capital, and all that. Even now, the financial value creation, I think, to some extent, is a function of the performance of other capitals. So, I'm not in full agreement at this point in time that everything should be in a balance sheet. Finally, what matters is if you're talking about the value of a company, their ability to create value, right? So then we know that they get manifested in our capitals. So I think in some form or the other, which is yet to be discovered. That's why I always advocate more and more academic research on this area. If we can, whether by giving numbers or otherwise, if we can come to some form of judgment, I would say, how these capitals, what we have and don't have, can impact our future cash flows, I think that would suffice. So, finally, if we are talking about company valuations, integrated reporting, I think this will be a path that integrated reporting will take in the future. That means the ability of the current capitals, the strength of the capitals to be able to create future cash flows. Perhaps now, like when we do discounted cash flows, we add a risk premium. Perhaps something of that nature might come, taking into account the quality of the capitals we have. So this is why we need to be more enlightened about. I think one of our earlier forums, I said, we are very different from what we were 10 years ago. So there will have to be more developments in time to come to make integrated reporting more helpful in doing company valuation, be it a premium in the discounted or a discount in a discounted rate or something like that. So let's see how it progresses. It's good if we can do it, but then I'll give you this example. Say we are an engineering company. I don't know whether I've said this before. So we need engineers. So please don't misunderstand me. I'll mention now Katubadda engineers are highly recognized. So say we have 10 of them. It's better to say that I have 10 engineers from Katubadda University with 10 years experience rather than trying to put a value to them. So future value is need not always be in a balance sheet. As an accountant, I'm saying this, but then let future research, academic research, look at these. These are issues actually.
Suresh, can I ask one question now? Your companies are valued by rating agencies.
Yeah.
Are these things of what we are talking, the value creation, are those things taken into account?
Right. To tell you, we have not taken a rating, so I'm not able to 100% say from, for whatever reason. From what I understand, they look at future value creation ability, but I don't think that they use integrated reporting frameworks to do that. They have their own models, I think. When the company is at risk, they make adjustments. Similarly, when the company has business plans, they make adjustments. For quality of management, they make adjustments. So like that, they may be having their own models, but I'm not sure whether the integrated reporting has a role to play directly.
Thank you. That's very useful. Now, because of the interest of time, I will quickly move to a couple of other questions. There was another question talking about audits, money audits, or talking about value for money or value for money audits provided as part of IR. Graham, what are your thoughts on incorporating value for money audits? Is that something that you think is relevant, or should that be done independently as part of an IR assurance framework?
I must confess that I don't know too much about the theory of value for money audits. So what I would say is maybe lacking in understanding what it is. But, if one's looking at assurance for the purposes of an integrated report, I think we all would say it's highly desirable if we could get that situation. I don't know whether value for money audits would help in achieving that, but providing assurance is extremely difficult for many reasons. There aren't frameworks and so on necessarily, the robust frameworks to be able to do that kind of work. I know the international bodies are looking at it, but specifically, I think any way in which information, integrity of information can be improved would be useful. But I'm not an expert on value for money, and so maybe one of the other panelists, maybe Samanthi, has a better perspective on value for money audits.
Professor Lakmika, if I can just mention one thing, just Suresh, for me. Actually, value for money audit is to determine whether there is value. So actually, the integrated reporting, integrated thinking, and implementing these by the company will show very good results at the VFM audit, value for money audit. That's what I feel, rather than the other way around, that if you implement this, then your VFM will be excellent.
Just to add one point to that, Lakmika, I think this VFM audit or performance audits, they are basically done on government, public entities, public organizations. So they are being focused mainly on these 3 E's: economy, efficiency, and effectiveness. But they are, as Professor Vatawala rightly said, that the essence of IR is there. But the thing is, these manuals that we used in VFM audit or the performance audit may not have been developed specifically in line with the requirements of integrated reporting. But now even the financial audits we do in corporates are not aligned towards these new developments in corporate reporting. So perhaps this now, as Graham said, the assurance or the giving some assurance on the information has become a theme, has been identified as an area of interest by IIRC as well. So perhaps in the time to come, certain changes would require in performance-based auditing, so that this concept that we discussed of value creation, value preservation, erosion, all that to be brought into the value for money audits, which are being carried out mainly on public sector entities.
Just a small word from me. Actually, I find that question very, very interesting because of this. If we are looking at outcomes or values, it's very important for us to connect the inputs and the outcomes or values, because value is finally outcomes are denominated through the value that is created. So if now I'll give us a very simple example. This I used in one of the seminars also. Say we train a salesperson or a customer relations person. So the input is we put money in, and the output is a trained person. Now that he can do things better. But one of the outcomes is, now say maybe he may have been earlier dealing with 50 customers, and now maybe if we can now deal with 100 customers, or if we can make the customers more happy, that is the final outcome that we want. Spending money on a person and say he is trained, which is the output, is not enough. So the value, the investment that we make is a financial investment, and the outcome or the value that he generates should be how happy his customer, how happier his customers are now. So as a basic principle, I find it very interesting, but to apply it in a complex organization, I'm not very clear about. But I think that may be a path that we should explore. It sounds very interesting to me. Actually, for all this, I'm looking to academic research, because these are areas for academic research, I would say, or at least the start of a whole lot of research.
Thank you, Professor. Sorry, thank you, Suresh.
Suresh said that actually this value for money audits, we basically auditor will have to look at the use of resources and funds within the entity against its stated objectives, basically. Therefore, it has to start with the vision, and it has to cascade down like that. I'm also not done much work in that area, but based on my understanding, yes, it's an area we can make use very well in the public utilities in the future.
Thank you, Professor Samanthi. Professor Vatawala, in the interest of time, I will bring this to a close and I will hand it over to you. Is there any other closing remarks that the panelists would like to make in relation to the updates? All right, there are no other comments to be made. I think in terms of the discussion, it was extremely useful, and I think some very important concepts have come out of this particular discussion, particularly around the framework. But as a closing remark and something to think about, I would like to put up a proposal or a thought leadership here in terms of coming up with something called IR Lite for particularly use of the SME and also not-for-profit sectors. Is that something that you think might be of relevance in going forward as the next iteration of integrated thinking, integrated reporting frameworks? Because as you know, the integrated reporting framework as it is mostly targeted at organizations who have providers of capital in terms of large organizations in most cases. But should this be stripped down a little bit to an IR light version where it can be used with SMEs and in some cases government sector and not-for-profit organizations? That'll be my last query, and I'll let each of the panelists talk about 1 or 2 minutes in relation to this proposition, and then I will hand over to Professor Vatawala. Graham, I will start off with you.
Okay, thank you. I think there's a lot of merit in what you're saying. I don't think that small organizations, SMEs, have got the resources and so on to prepare an integrated report. However, what they're losing out on is the thinking that's behind it. But they still need to do reporting within the organization. And to me, reporting in an organization should take into account the principle or the most important elements of integrated reporting that relate to that organization. So I think it can be adapted for use by SMEs. But you want to take out all the clutter. You don't want the management of the organization having to worry about irrelevant information. What is critical to that organization, running of that organization? Something like understanding that external environment and looking to the short, medium, and long term is as important for them as it is to a major corporation. How they do it, I'm not too sure, but I think one could prepare some kind of framework that helps smaller organizations take advantage of the benefits of integrated reporting and thinking.
Thank you,
I won't talk about the public sector because I think that's equally important.
Sure, thank you. Professor Samanthi, a quick comment on this?
It's good for SMEs. I think rather than preparing a report, we have to get them to embrace the concept first. Otherwise, they will just prepare a report for the sake of preparing a report. So in my view, if we can develop a dialogue so that this concept could be taken there,
Sure.
so that their decision making will be improved based on which.
In other words, what you're saying is that SMEs would need to talk about integrated thinking or embrace integrated thinking first. It's interesting that Deakin Integrated Reporting Center, we are hosting the BRLF, the Business Reporting Leaders Forum in Australia. And one of the special interest groups are actually discussing this IR Lite concept at the moment. It is being headed by Darren Scammell, who is a partner at Grant Thornton, one of the audit firms in Australia. So thank you so much. Suresh, do you have anything to add to that?
Yeah, I think that's very interesting. Like Professor Samanthi Sena said, it's very important. It's more than the report. Embracing that concept is very important. Actually, I'll tell you something a little interesting. Today, I was talking to the accountant who is a key part of our integrated report. And because tomorrow I have to talk to some undergraduates about integrated reporting. So I said, okay, what is the best way? Because I have my own analogy, so I thought I will think of something new. And I asked her, so because she graduated about 7-8 years ago, but she has mastered integrated reporting now. She said the best way is to ask them to do an integrated report of their own life, because you have a purpose in life. And that idea was fantastic. You have a purpose in life. Okay, let's say I want to be happy in life. So what are the important things that will make me happy? So say maybe my children have to be happy, my wife has to be happy, my workplace has to be happy. So so what is the value that they have for me? So my happiness will depend on how they value me. It's not only the money that I have or don't have. So I think you can take it in a very simple form. That idea is fantastic. So I think that's a very good way of thinking about anything.
Yeah, thank you. I think that will be very relevant to the SMEs to think of it in that perspective. So thank you very much. And last but not least, Mr. Hennayaka, do you have any last comments to add?
Yeah, Professor, I think even though there are limitations in terms of resources, I think it is worthwhile to make SMEs also aware of the concept of integrated reporting. That's the message that I can.
Thank you, Mr. Hennayaka. Professor, I hand over back to you. Thank you very much.
Yeah, right. Thank you. I think before I say something, I think I have just invited a very, very distinguished person, Dr. Jagan Mohan Rao. I think he is a past president of SAFA and also a member of the Institute of Cost and Cost Accountants of India. Jagan, are you there? Dr. Jagan, are you there? Or
Has connected, but I think he's on mute.
yeah, he's on mute. Let me see whether right
yes,
now.
Yes, sir, I am there.
Yeah. Just 2 minutes. You just say a few words as a very distinguished participant, as a past president of SAFA.
Yeah. Thank you very much, Professor Sir, for giving me this opportunity. And it's very nice to see all learned speakers speaking on the subject. And I am also grateful, and then I'm very happy and pleased to see our SAFA Vice President, Mr. Nayak Bandara. Greetings to you all. But see, as far as the integrated reporting is concerned and SMEs, it is too long a time now, as I think you also mentioned that it will take a lot of time. But in any case, for the success of integrated reporting, we need all people to understand what is integrated reporting and the value. Any promoter, any director, any entrepreneur would always look into what is the financial benefit when you have a part of any reporting anywhere. So the balance sheets and then annual reports are prepared basically from the angle of giving it to the institutions and getting the loans, or circulating it to the stakeholders. So that message has to go into the minds of the people to understand that it is an asset, and then it gives you value addition. So creating value addition through the integrated reporting is essential, which is probably the responsibility of all of us, the professional accountants. Thank you very much.
Right. Thank you, Dr. Jagan. I think also for your presence. We've been able to connect up because of the current connectivity that we are having. But I just want to, before I hand over to Mr. Hennayaka to maybe to give the vote of thanks, I think today we really got maybe the crux of what changes are there, and we are very happy that it's not a very, very major revision. I think our conclusion, which Professor Lakmika came up with, I think that is a very, very good suggestion plus a practical solution. Because we are also now dealing with a lot of SMEs, and the biggest weak link is on the accounting area. A lot of them not maintaining these proper books of accounts, and but we'd like to see this the IR light. I think that is something not only for the SME sector, but as you said, the state corporations, the government sector, the government ministries. If we can introduce this, I'm sure the government also will be very, very interested in such a project. And if you all are doing that in Australia, I think this is the best that we can do because we need to now get our numbers and spread it, because on the integrated reporting, it's still the numbers are maybe not that substantial, but all the bigger companies are coming so that they are the major contributors to the GDP. So I feel that we can really make use of this IR light, which we'll have to see how we can fit it, and then that will spread the value creation concept throughout. I think that's what we need to do, because if we can really look at it in that concept, integrated reporting, integrated report thinking will be a great success. So I must thank Dr. Lakmika for that very, very constructive suggestion that you made, and I'm sure that you will assist us to take it forward. So I must thank all, but let me officially invite our Vice President and Vice President of SAFA, Mr. Hinnai Kamandara, maybe to give the final footprints.
Ladies and gentlemen, thank you. Thank you, Professor. If you take Mr. Graham Terry is not really a stranger to CM Sri Lanka. He has been involving with integrated reporting awards and helping us last 5 to 6 years. And on behalf of CM Sri Lanka, let me thank Professor Graham Terry for the excellent and detailed presentation that he has made on the new areas of integrated reporting. I'm sure that the presentation or other detailed explanation that he has given would have benefited to all of you. Let me also thank Mr. Lakmika Pera, who has been helping us again last couple of years on this subject area. And Ms. Samanthi Sena Ratna, as well as Mr. Suresh Gunaratna, for the valuable contribution that you have made during the course of the webinar. And I'm sure that you will be able to share your experiences in the future as well. Let me also thank our Professor Patavara, who is behind this webinar and always very keen on promoting the integrated reporting, not only here, but even if we take the South Asian region. So let me thank Professor as well as the CMA team for the support that they have extended to conduct this webinar. So ladies and gentlemen, thank you all for your participation, and I'm sure that we will be able to invite you in the future as well for similar program. Thank you very much.
Thank you. Thank you, Hennaka, and thank you very much to all our speakers, panelists for the time that they have devoted, and also to all our participants, and of course, Dr. Jagan Mohan from India, who is here with us today. And wish you all the very best and look forward to maybe take forward this journey, because it was mentioned that IR is a journey and that it is now emphasized in the new changes that are taking place. So Suresh, I am sure that you will be there with Professor Samanthi, Associate Professor Lakmika, and of course Professor Graham, so that we'll be able to go forwards. Thank you very much and all the very best.
Thank you, Professor. Thank you, panelists. Thank you so much. Bye-bye.
Thanks, Graham. Okay, brilliant. Thanks, Graham. Thanks, and okay. End up. Okay.